than the Americans, so.
Yeah. All right. Proposals to gut the financial sector. Now, a lot of these are proposals for Scotland, so somehow one fits into the other. Number one, permanent zero rate policy. Again, I don't, like, why not? And you know about the University, UMKC, Buckaroos, right? I already went through that. There's always a zero rate policy. Okay. Eliminate tax advantage savings incentives. What's that all about? Chapter 6 in the 7 Deadly Innocent Frauds, that out there's this understanding in Congress, it's a deadly innocent fraud, that we need savings to have money for investment, which is completely backwards. Savings is the accounting record of investment, causation of investment to savings. You know, it's just backwards, but they have it backwards, and we're going to eliminate those because when they put on tax advantage savings incentives, in the US, you put money in your pension fund, it's before tax money. So if you earn $1, you either pay 30 cents in taxes or you can put the whole dollar in savings until the end. It's compelling not to spend your money. So we have all these tax incentives not to spend your money. What does that mean? It means there has to be deficit spending on the other side, or else, what these guys call ex post. When we look at last year's numbers, the income and the savings won't be there. Somebody has to spend more than their income to create the savings that you're going to put away. So what it does is it creates, that's what's creating these giant pools of savings. The 40 trillion under management by asset managers that are doing all the damage. So what we're trying to do is cut off the source, cut this stuff off at source. My idea has always been, rather than pay out $1 and then try and claw it back, don't pay it out to begin with. Okay, and that's the whole thing's centered around it. Required public companies to offer unlimited new shares at a fixed price. They'll be above their current market share. That will end stock market appreciation in terms of price. Investors will still get more value through earnings and dividends, which is what the whole investment theory is all based on anyway, not a price speculation. And it eliminates vast numbers of people involved in the fact that stocks trade all, go up all the time. Full bank deposit insurance and unsecured overdrafts at the Fed and apply in Europe also. That's the logical conclusion of anybody looking at a banking system from a clean sheet of paper versus what we have now. And it eliminates another big chunk in the financial sector. Okay. Direct employment in the financial sector, over 3 million people. These are big numbers. Over 1 million employed in capital markets. How much do they make? 98,000 to 180,000 average salaries. These are large numbers even for the U.S. Costs with the financial sector. Now I look at real compliance costs, not the money. Legal expenses, you can look at the numbers, JP Morgan, I don't know, $10 billion a quarter or some crazy thing. But what's behind that? All the people getting paid for that, all the lawyers, all the clerks, all the people teaching them at school, the professors, their educations, all the court cases, the paper. The court won't just give you a file, they have to print everything. You know how many trees are cut down for these courts? It's crazy. And, but all the associated legal expenses, all the anxiety associated with getting sued by the IRS or having to do all this stuff, all the medical attention you need, it all goes away. Audit expenses. This is staggering costs. They're all gone. Educational expenses, energy consumption. Massive amounts of energy consumption and all this from everything, from all angles. I'm going to race through this a little bit. Regulatory expenses, government expense to monitor and regulate all this stuff. Just think about what all the regulation behind the stock market, all the regulations behind that, all the banking regulators. Computational resources. I don't even remember what that is. The computers and all the
data science.
Huh?
Data centers, all
Yeah, yeah.
power.
Yeah, data centers are using more energy than the whole city. Proposed permanent zero rate policy. What does that mean? The banking system's cost of funds is zero. How do you do it, by the way? You just, when the government deficit spends, it credits accounts, and then money just stays in those accounts. It's really simple. You don't sell bonds, and you don't pay interest on the accounts. Japan's been doing it for 30 years. Right? And there are no bad effects. It's one of the nicest places to live in the world, and no issues about what might happen if we didn't have government securities, except you eliminate, whole armies of bond traders and that whole cottage industry that's spawned around it. And think about the income distribution issues that this thing feeds, right? Because of the tens of millions of dollars a year these managers are making to do something that doesn't need to be there. I mean, they could be out curing cancer or doing something useful. So, cost of funds is zero. It doesn't mean all interest rates are zero. Rates are risk adjusted. In Japan, the cost of funds is zero, but mortgages are at 3%. Okay, maybe a corporate loan that's a risky business might be 5%. The market figures that out. But their cost of funds is zero. You're not giving the banks free money or anything like that. That's their cost of money. To make money, they have to find a borrower and then compete with the other banks, and the spreads get compressed. I could show you a chart of bank interest margins. It's not much, and it's thin and it goes down. Okay, so it's not about giving anything to the banks. Okay, bank lending prices, risk adjustment, unlimited overdrafts for member banks. Okay, and the reason for that is the way it works now. If I've got make a payment to you and I've got my money in a bank, and I write a check and give it to you, and you deposit it in your bank, and the check clears, you've heard the word clear. How does money disappear from my account and get into his account, your account? And what happens? Nobody takes a wheelbarrow and runs across the street or something. Banks, what they do is both banks have an account in a third bank, which is called a clearing bank, the central bank. It's between the banks. I have an account there, your bank has an account, my bank has an account there, your bank has an account there. So when I write a check, what happens is, the Federal Reserve or the ECB, the central bank will subtract the money from my bank's account and add it to your bank's account. And now both banks, have the correct information and they can account for everything. And however, if neither of us have any money in our account to begin with, neither bank has any money, my account is now negative and the other bank's account is positive. And what happens today in the market to reconcile that is my bank has to go to your bank and borrow the money back. And then the Fed lends it, because once the money's borrowed, then it goes from your bank, it's loaned back to my bank, and both banks are back to zero again. Okay, so I pay you, my bank has to borrow the money from your bank, to clear this thing. And that's how it works. So who's doing all this borrowing and lending back and forth between banks? That's called interbank lending. These people don't come cheap, okay? And there's thousands of them. We have 4,000 banks in the United States. You've got all these people tied up in doing this. It doesn't have to be that way. The central bank can just say, one bank's negative and the other's positive, and just leave it like that. They don't have to do all this other stuff. These aren't gold coins or anything, right? And if you just leave it there, what does that mean? Okay, it means my bank's borrowing it from the Fed instead of borrowing it from your bank. So what? It doesn't matter. It's never mattered. And this way to do things is how banks in emerging markets start until they're sophisticated enough to start having interbank people doing it the other way, spending money on compliance and everything else. So anyway, you don't want to hear any more about it. But, so unlimited overdrafts to bank members, it doesn't mean banks can now borrow all they want and lend all they want. Lending is not constrained by how much a bank can borrow. There's not a line of borrowers at a bank waiting for them to get the money. Have you ever gone to your bank and they say, oh, okay, wait in line, we don't have the money yet? Of course not. Okay, the bank lending is constrained by people borrowing, by credit-worthy borrowers. And when you can find a credit-worthy borrower who borrows money, what you do is sign a promissory note, and the bank buys that note from you and puts that number of dollars or pounds in your account. And then that note is an asset. Okay, and then if you wanna take that money out, it has that asset to borrow money. You can borrow it just as easily from the central bank through a overdraft as you can from another bank to get back the funds that you just moved out. Anyway, unlimited overdrafts, there's no moral hazard, there's no operational anything associated with it. Nobody would ever know the difference. No treasury securities longer than 3-month bills. Bonds, no bonds. I'm in the no bonds, but for the US, institutionally specific, the treasury can decide whether it wants to do 30-year bonds, 10-year bonds, or 3-month bills. It makes that decision. It's called debt management. They can just decide to go to 3-month bills. It doesn't require any legislation, any approval by anybody else. It's just a policy change. So if the Treasury Secretary says, we're only going to go 3-month bills, it's done. 3-month bills don't get traded. They don't have this huge industry out there supporting $1 million salaries and all that. They're just like regular cash, the way they're used. So for institutional simplicity, we just say nothing longer than 3-month bills, and it can get done tomorrow. It doesn't have to wait and go through this whole vetting process and everything else. And it's with a zero rate policy, so the interest is going to be zero on all those. And in fact, Treasury bills tend to trade at a lower rate. If you have zero rates like Japan or like we had in the US, it was not uncommon for Treasury bills to trade at negative interest rates. The Fed will have a bid for longer dated securities so that the long-term Treasury securities out there, there's not going to be any market, so we don't need any bond traders, and they'll eventually mature. That used to be the joke back when I was in Bankers Trust. What's the difference between bonds and bond traders? The bonds eventually mature, right? So the outstanding bonds will just be there to be sold to the Fed at near zero rates, maybe 5 basis points. So there'll be no money, no incentive for anybody to be out trading bonds anymore. And so this is getting rid of this permanent zero rate policy with a couple of operational things with it. It's getting rid of a big chunk of the financial sector. Right? Now, what's wrong with the financial sector? In 1976, I was working at a savings bank in Manchester. I was paid $140 a week. We left at 4 o'clock every day and played golf. We took in deposits at 5%, loaned out mortgages at 8%. There were 2.6 million housing starts that year. The population was less than 200 million people. Today, with 350 million people, and the financial sector now 30% of GDP, S&P earnings. Back then it was under 5%. It was just us guys running the stupid savings and loan for no money. Easy thing. Today, with this massive financial sector, housing starts just came out today, 1.4 million, with almost double the population. And it's like picking up, it's looking good, right? The financial sector doesn't add anything to financing anything real in the real world. All you need is a couple of clerks, people walk in, they qualify under the rules, you give them the loan and they walk out. You don't need all this other stuff around it that we have. And it's staggering in its, size, complexity, and eating up real resources, using up real energy that can either be not used or deployed somewhere else. Real gains, eliminates interbank lending, eliminates trading of treasury, eliminates interest expense. You know about that, I don't have to say anymore. Low hanging, 1.2 trillion a year now. Eliminates tens of thousands of those employed in this aspect of the financial sector. Eliminate tax advantage savings incentives. We talked a little bit about it. For every entity that spent less than its income, another spent more than its income, or else the numbers wouldn't be there. Tax advantages provide incentives to not spend income. This income can't be realized without deficit spending by another entity. All these people who are against big deficits, they're in favor of big savings incentives. They're creating their own thing that they don't like. Public and private deficit spending are the source of investment funds for the financial sector. So this is all loans, creates deposits, investment creates savings, and that all gets is the source of the funds, the 40, 50, 60 trillion dollars under management, getting seriously large fees, paying people seriously large amounts of money, and being fed upon. They're the whales, okay? They're not the sharks. The sharks are the Wall Street groups that hire the best of them, pay them 10 times as much to call their old buddies to make sure that they get the business off of them and make their money off of this sector. Those are the 40 to 60 trillion dollar whales that the sharks of Wall Street are feeding on. And you just cut off the food supply. It all goes away. You haven't done anything personally to anybody. It's just not there anymore. Eliminating tax advantage eliminates the savings desires, because they're created by taxes. Facilitating the deficit spending creates the funds that support the financial sector. So we're going to take away its support by changing the savings rules, and then it just goes away. Instead of leaving everything in place, letting them make hundreds of billions of dollars, and then trying to figure out how to tax it, tax transactions, taxes, which never happens. Not that I'm against it, but it's not going to happen. It just doesn't happen. Real gains from eliminating this: the reversal of the rapid growth of the then contracting vast pools of savings, transitions tens of thousands of financial professionals to other sectors. It's a huge brain drain. These guys have gone to Wharton and the LSE, they're the top people out there. Instead of curing cancer, they're doing this stuff. Okay, this makes no sense at all from a public purpose point of view. Real investment will continue to create its own savings, both through the banking system and private funding markets. It's not going to interfere at all with real investment. In fact, you get all these people now doing other things. You'll see, the real investment that we like expanding exponentially. Total assets under management was higher than the value of assets under management in Europe. 47 trillion US dollars in 2022. I assure you it's gone up substantially. Require public corporations to offer unlimited new shares at a fixed price. It puts a ceiling on the price of the stock. If the stock's at 10, but the company has to issue unlimited shares at 20, it's never going to go above 20. Once the price is 20, now you're buying new shares from the company. They're offering them at 20. It's not going to go to 21 because you can buy new shares from them. It's giving the company money, which will earn interest initially. Of course, under zero rates, it's not going to earn very much interest. But it's there as an asset of the company. It's not taking anything away from them. If that means the return on equity isn't high enough to attract investors, you're not going to pay 20. Because when you buy it, you know what happens to the company. And if that causes it, and if you make a mistake and buy it, and you have to sell it at 18 or something, well, that's your problem. At 18, somebody's buying it because it's a good investment based on what's going on in there. The investment is based on the earnings of the company and their ability to eventually give you back more money than you started with this MCM. And so that's what investment's all about. That's how the investment models work, private equity and everywhere else. It's only the stock market thing that it turns into a casino. So we take away the casino aspect of it, and it takes away all the people servicing the casinos, right? And not that these people have any political influence, but to the extent that they do, that goes away. And I think that might be very helpful. And this existing investors who purchase at the lower price benefit from new shares. So nobody gets hurt. Investment works out the way it's supposed to work out. The incentive to speculate on price is largely eliminated, which means all that stuff goes away, which is the important thing. Trading in stocks is dramatically reduced. Buybacks are largely eliminated. All this financial manipulation goes away when you don't have something to manipulate. Just take away the toys. Okay. Real gains from capping stock prices. Tens of thousands of people directly and indirectly involved in stock trading lose their livelihoods and be redeployed to useful endeavors. Any environmentalists have any ideas where people could get redeployed to? Okay. Massive quantities of real resource and consumption. All these guys have computers. They don't have the cheap ones, okay? They don't have the ones that burn 10 watts of power. They're looking at the 50s and 75s. The load on the grid would probably drop in half without this. Massive quantities of real resource consumption seized can be redirected or curtailed. Banking proposals. Full deposit insurance eliminate the need for money market funds. All those money market funds? Instead, you just put your money in the bank. Why don't people do that? Well, they're worried about security, and the money market funds have collateral, treasuries on it. Okay. If you have full deposit insurance, you put your money in the bank. They're saying, well, what about the pension funds who need government bonds or whatever? Put their money in the bank. If it's government insured, that is a government bond. Okay, nice and simple. And again, 30 years this has been going on in Japan with no bad side effects. So I don't wanna hear about need these to be determined prices and asset values. It's fun. I was there before any of that was there. When I first started, there were no treasury long bonds. We got along perfectly well without it. Unlimited collateralized borrowing from the discount window, we talked about this, eliminates liquidity issues and interbank trading. You know, if I write a check to one of you guys, the money goes from, the Fed changes the money from my bank to your bank, and your bank won't lend me the money, because, I don't know why, the guys out playing golf won't answer the phone. We have a banking crisis like SVB. That's all they are, liquidity crisis. It had nothing to do with their assets and quality of earnings. You know, it's like if the president's Bank of America, if somebody sees his wife with a Citibank charge card and starts a rumor that Bank of America is in trouble, he'll be gone tomorrow. That happened in 2008 with Wachovia. They were gone the next day with $40 billion in net worth. The Fed had to liquidate them because nobody would lend back the money that depositors were moving around because everybody was petrified. Okay, that all goes away. Eliminate financial assets as qualifying collateral. Eliminate state-sponsored financial leverage. You can take your stocks now, go to the bank and borrow against them. You can take your bonds and go to the bank and borrow against them. That's speculation. That feeds speculation. I buy stocks, borrow the money to pay for it. I don't have to put up very much. I can buy twice as many or 10 times as many, depending on the leverage ratios. Right? Why are we doing this? Now, an individual wants to do it for somebody else, that's one thing. But when it's through the banking system, this is state-sponsored speculation. What is the point, the public purpose behind that? Just don't allow it. Okay? Retention of agency-issued mortgage-backed securities. Okay, this is a little more interesting. This is what PJ was talking about before. So, when you take out a mortgage, whoever holds that, whoever loans you the money has a risk. It's not just the risk of your house. There's a risk because if interest rates go down, you're going to pay it off and refinance. So he thought he had a 30-year mortgage, and all of a sudden he's got a 1-year mortgage. And if he was counting on that because he had promised somebody, like a pension fund, a 30-year return, something like that, for 3 years, he's in trouble. Okay, and the reverse happens. If interest rates go up, something he thought that was going to pay off over 6 or 7 years, the mortgage normally might stay out there for 30 years. And now rates are higher and his money's stuck.
And it gets replaced at the lower rate.
Right.
So
Right. So, yeah. So what Peter is saying is, if I've got an investor and I buy a 7% mortgage because rates, that's what they are today, all of a sudden rates go back to where they were, mortgages are 3%, you pay it off, now I'm stuck with the cash, I gotta reinvest it at 3%. Because the new mortgages are 3, now I've got a 3 instead of a 7. Well, that's not what I wanted when I went to 7. Vice versa, if I put on a 7% mortgage today, I think it's gonna be a 6 or 7 or 8 year mortgage, because that's average payoff. Rates go to 10, I'm gonna be stuck with this thing forever. So I have a risk. It's called convexity. Fancy name, it just means you're backwards on this. And so because of that, I have to get a higher yield to make up for it. So today the 10-year note treasury might be 4.5%, but I want 7 on a mortgage because I've got this risk. I don't know if it's going to be a 1-year or 30-year. And it's whatever it is, I know it's going to be working against me if it happens. If it's a 1-year, it's because rates came down and now I'm stuck reinvesting at the low rate. If it's a 30-year, I'm stuck with my bonds. So it's a lose-lose for me. So the question is, how much higher do I have to charge you, to make up for that? So mortgages are always more expensive than you'd expect just looking at rates in the newspaper or something, because the lender's taking this risk. Now you're getting a benefit. If rates go down, you get the low rate. It's great. If rates go up, got them. Plenty of people now with 3.5% rates going great. Rates are 7. So you're getting the benefit, they're getting the loss. If the government, the Fed, who bought all these mortgages, or if the mortgages had been funded by them to begin with, they can loan the banks money. They don't care about that convexity. Okay, so what happens to a private sector lender who has all these mortgages? He has to do what's called hedging. He is in, if he sees rates starting to go down, and he has this stuff, he's like, oh my God, rates are going down, I'm gonna lose all these, I've got to sell. And if rates start going up, it's like, do I have it right? Yeah. box. So they're always like buying and selling like crazy to try and offset this risk that they have. They have complex financial analysis that use computers, that use energy to try and figure out this risk. It's an enormous business servicing these guys because they're buying and selling all the time to try and hedge this risk. It all goes, anyway, it all goes away if the government holds it, because they don't care. You pay it off, fine, money goes into the government. If they have it for 30 years, they have it for 30 years. They don't care. They don't have a funding cost on the other side. So it serves public purpose to retain mortgages, to have mortgages all held by a government agency rather than the private sector. If it's in the private sector, it causes volatility. It causes a whole herd of people to have to buy and sell all the time, moving markets more than they'd otherwise move to try and mitigate this risk. Okay, and so you don't want that. And with the Federal Reserve having bought all those mortgage-backed securities, the volatility in the treasury market and the interest rate markets went way down, which was a good thing. I've never seen them write it up, but anyway. Real gains from banking proposals eliminates tens of thousands of people, directly and indirectly, in current banking activities that can be redeployed to useful endeavors. And that's